Are we in a recession or not? Hi, I'm Jeffrey Roach, Chief Economist for LPL Financial. In this Econ Market Minute, I'll give you 3 highlights of the past week and 3 potential market movers for the week ahead. So let's start with 3 highlights from this past week. First, the decline in consumer confidence tells us that the economy is on unsure footing. The Consumer Confidence Index fell for the 3rd consecutive month, indicating that consumer spending could likely slow as income expectations weaken. As borrowing costs rise, consumers indicate waning demand for large purchases such as cars and homes. July home buying plans have not been lower since 2013, when the economy was reeling from the great financial crisis. A weakening residential real estate market will add downside risk to economic growth in the 3rd quarter. Second, the Fed raised the upper end target rate by 75 basis points to 2.5%. Committee members are increasingly concerned about weakness in consumer spending and manufacturing. The one bright spot right now is the labor market, as job gains were solid the last few months. However, as businesses increase layoffs to cut costs, the job market will likely cool in the latter half of this year, complicating things for central bankers. As long as inflation pressures remain, the Fed will feel compelled to continue tightening financial conditions. So therefore, the FOMC could raise the target rate another 1% by the end of the year, but that is predicated on a solid job market, which is not a guarantee, as businesses have recently increased layoff announcements. The scenario investors can hope for is best illustrated during the mid-1990s. The economy escaped recession as the Fed pivoted from increasing rates to cutting rates when labor markets weakened. Third, we are not in recession yet. Consumer spending was too strong to raise any recession signals in Q2. Consumers shifted from buying goods to buying services, and after adjusting for inflation, real consumer spending rose 1% annualized from the last quarter. However, higher interest rates are weighing heavily on business investment. The decline in total private investment was broad-based and could be an ominous sign. Investors should not be surprised in the decline in commercial and residential real estate, but the decline in general business capital spending reveals a budding weakness in the corporate sector of the economy. The Fed will likely interpret this decline in real growth as confirmation to slow down the pace of rate hikes at the upcoming meetings. Front-loading rate hikes eventually mean smaller hikes in the near future. So how about 3 potential market movers as we preview the week ahead? So first, survey of purchasing managers will give us a deeper look into July business activity. Highlights within this report will likely be the prices paid component, employment, and the latest on backlogs, which give us a read on the latest supply chain conditions. Second, investors need to really focus on the weekly number of initial unemployment claims. Rising initial unemployment claims are ominous for the outlook. Initial unemployment claims are trending upward, a more concerning sign than the recent negative Q2 GDP report. After yesterday's update, the 4-week moving average of initial claims has trended up since the beginning of April. And as a note of caution, rising claims indicate a weakening labor market. Third, the July jobs report will come out on Friday morning. We need to carefully track the labor force participation rate, which ticked downward last month. This is an important figure because it tells us how many working age adults are actually working or looking for work. I find it helpful to track participation rates by age, as this gives insights into the maturity, experience, and productivity of the labor force. Well, that's all for now. See you next time for more economic insights for your week, and be sure to follow me and the rest of the LPL research team on social media for regular global market updates.